Hey everyone, welcome back to the Explainer from Talk Tickers. Today, we're diving deep into the Q2 2025 earnings call for Urban Edge Properties. That's ticker UE for those of you following along.
All right, so let's get right into the big question. The paradox of the quarter, really. How does a company miss on revenue and still see its stock surge? It's a great story, and we're going to unpack exactly what happened.
Okay, so first up, let's look at the raw numbers. You can see here revenue. Yeah, it came in just a little light, about 1.6% below what analysts were expecting. But, and this is the important part for a REIT, look at the other metrics. Funds from operations, or FFO, that beat by a solid 6%. And GAAP EPS, that was just a massive outperformer. So right away, you can see the market was looking past that top-line number.
And the market absolutely knew what to focus on. On the day of the earnings call, the stock just ripped higher, closing up 6.3%. And get this, it was on volume that was more than double its recent average. So investors were clearly piling in.
And this chart really puts that move into perspective. It's not just a one-day thing. You see here, over the last 3 months, Urban Edge has just crushed it, while the broader real estate sector, represented by the ETF here, has been kind of flat, even slightly down. UE is up big. It's a real story of outperformance.
So, that brings us back to the big question, right? If it wasn't that top-line revenue number, what on earth did investors love so much? Well, the answer isn't on the surface. You have to look deeper, inside the company's core operations, what I like to call its leasing engine.
And here it is. This is one of the key numbers that got everyone so excited. A record high 92.5% shop occupancy. That is a huge jump, 270 basis points from just a year ago. That tells you their properties are in seriously high demand.
And you know what high occupancy means, right? It means pricing power. The CEO, Jeff Olson, put it perfectly. He said there are so few good spots left in their markets that they're getting multiple bids for the same space. Think about that. They're not just jacking up rents, they're getting better lease terms all around. That's a fantastic position to be in.
Okay, now this is where it gets really interesting for anyone thinking about the future. We're talking about their signed, not open pipeline, or SNO as they call it. This is basically future growth that's already locked in. These are leases that have been signed, sealed, and delivered, but the tenants just haven't moved in and started paying rent yet. And we're talking about a whopping $24 million here, which is like 8% of their current income. And you'll love this, over 95% of these are from stable national brands. So it's very, very high-quality future revenue.
All right, let's zoom out a bit and look at the bigger picture, the grand strategy here. Because all this leasing success is happening while management is actively reshaping the whole company through a really smart strategy called capital recycling.
So what is capital recycling? It's pretty simple, really. It's like a strategic portfolio makeover. They sell off their older, lower-growth properties and use that cash to buy brand new, higher-growth, higher-quality ones.
And here's the proof that it's working beautifully. Look at the numbers since last October. The properties they sold had about a 5.2% rate of return, what we call a cap rate. But the new properties they bought with that money, they're yielding 7.2%. That's a 200 basis point spread, a massive difference that flows directly to the bottom line while also making their entire portfolio way better. It's a total win-win.
I love this quote from the CEO. He said a board member called this moment the revenge of the nerds for shopping centers. And it's so true. For years, everyone thought physical retail was dead. But now, investors are flooding back to these open-air centers because they're realizing just how durable and steady the cash flow is. The nerds are definitely having their moment.
So with all this operational strength, it's no surprise what came next. Management felt confident enough to actually raise their guidance for the full year. They bumped up their FFO forecast, which is a huge signal to the market that they see this momentum continuing.
And this isn't just wishful thinking. Their positive outlook is built on some really solid pillars. First, you've got strong income growth from their existing properties. Second, they're keeping a tight lid on costs. And third, and this is super smart, they're actually viewing potential tenant bankruptcies, like the situation with At Home, as a chance to upgrade and bring in an even better tenant at a higher rent. They're playing offense.
Okay, so that's the story of the quarter. But the crucial question for all of us is, what does this all mean for the stock from here? Where do we go now? Well, here at Talk Tickers, we've got a clear take on it.
When you step back and look at it, the bull case is just incredibly clear. You've got that SNO pipeline, which is growth that's already baked in. You've got massive pricing power in their core markets where there just isn't much new supply. You've got that accretive capital recycling strategy firing on all cylinders.
a fortress balance sheet, and to top it all off, you have a stock that even the CEO calls relatively inexpensive compared to what these assets are worth in the real world.
You put all of that together and the picture is really compelling. And for all those reasons, we are initiating our coverage with an outperform rating.
So what's the actual trade idea here? Well, we call it the valuation gap play. Essentially, you're betting that the public market, the stock price, is going to wake up and realize these assets are worth more. The big catalyst? That S&O pipeline we talked about. As those signed leases start paying rent over the next few quarters, the cash flow is going to pop, and we think that will force the market to re-rate the stock. Right now, the stock is trading at an implied return, or cap rate, of around 7%. We see that tightening closer to the 6% you see in private deals. That gap closing could mean some pretty significant upside for the stock.
This is not financial advice.